Hello, everybody. Adam Bergman here, tax attorney, founder of IRA Financial. And on today's video, IRA and Roth IRA Basics Masterclass. So we're going old school. We're going back to the basics. So next 30 or 40 minutes, I will teach you everything, yes, everything you need to know about the IRA and the Roth IRA. And I'm also going to throw in the step and simple for free, for good measure. What I find is every year it's helpful to go back and just kind of touch up and discuss the basics, because fundamentally it's so important to understand how an IRA and Roth IRA works so we can take advantage of all the amazing rules and make us a better, smarter, and wiser self-directed investor. This is what I just did with my team. Every year, every January, with the IRA Financial team, I do a Teams, just because make sure everyone can participate. And we go through this presentation, literally this one. And it's so important that everyone understands the IRA and Roth IRA basics and just keep up to date, because people get busy and get focused on details and minutia, but sometimes got to go back to the fundamentals. So obviously who I am, Adam Bergman. I founded IRA Financial about 13 years ago. We've over 23,000 accounts, $3.3 billion in assets. We've helped lots of people, lots of smart clients. I love what I do. I've written 8 books. This is my passion. I don't think there's many people in the country that know IRAs, Roth IRAs, self-directed IRAs better than me. This is what I love to do. This is what I spend all my time doing. So hopefully you guys get it, enjoy it, and we can learn from each other. So as I mentioned, these are the type of IRAs we're going to go into. IRAs were created in 1974 by ERISA. Prior to 1974, there was no IRAs and no 401ks. Only large Fortune 500 companies offered what is known as defined benefit plans. Okay, they were like pension plans. They basically provided their employees with a defined life benefit, which some businesses like GE, IBM, Ford, some of these companies are still paying folks that we used to work there 10, 20, 30, 40 years ago. So it became quite a financial burden on some of these businesses. So ERISA was promulgated in 1974, almost 50 years ago, and it created an IRA and a 401k, more of a type of retirement account that is private, right? It's up to us to take advantage of it, whether it's contributing to a 401k, contributing to an IRA or Roth. We have to do it. Okay, we can't wait on our employer to do it, which is important because being American, we respect freedom, we respect control, and it's up to us, right? The retirement system, I'll say it, I keep repeating this on every video I do, and it's true. It's a zero-sum type of system, right? Everyone can do it. We all could have millions of dollars tax-free, right? It's not zero-sum. Like, everyone could do it. We just need to understand how the rules work, and that's why it's so important to understand fundamentally how an IRA or Roth IRA works. It's based off mathematics, compounded returns, which I'll get into, but it's a system that has bipartisan support. It works. Republicans, Democrats, it's the one thing they agree on, right? We know Washington can't agree on anything, whether it's foreign policy, domestic. There's a million things I don't want to get into. I'm always scared to touch on politics. I was actually going to do a podcast on this as a New York lawyer, like this Trump verdict on he owes $350 million on this loan. And again, I'm not a political person. I'm independent. I'll vote Democrat. I'll vote Republican. Kind of depends on the person. But as a New York lawyer, like that, I just had a real issue with that ruling. So I may do something. I just don't want to upset people, because at the end of the day, the retirement system is bipartisan. It works for all of us, whether you're Democrat, Republican, whether you live in New York, Florida, Texas, Idaho, it doesn't matter. It works. Okay. So today's video, I'm going to go on the IRA. I'm going to go over the IRA, the Roth, the SEP, and the simple. I'm going to tell you everything you need to know about these accounts. Once you finish watching this video, you can forget about IRAs for the next year, because it's going to be ingrained in your head. You're going to be good. I promise. Okay, we're going to start with the traditional IRA. It's the most popular type of IRA. Starting in 2024, you can put away $7,000 or $8,000 if you're over 50. We're going to get into the income limitations in a bit. 2023, it was $6,500 or $7,500. Now you have to have earned income to make contributions. Earned income is compensation for services. Whether you sell a service, you sell a widget. If all you have is disability, Social Security, capital gains, interest, dividends, royalties, rental income, you can't make an IRA contribution, right? So let's say you have $500 million of capital gains because you sold your business for $500 million bucks. You never took a salary. Technically, you can't open a traditional IRA, right? So you need to sell a service or a widget, okay? The advantage of a traditional IRA is you get a deduction for the amount you contribute. Now, again, it's self-serving. You can put 0 in, or you can put 7,000 in, or 8,000 if you're over 50. It's up to you. No one's going to put it in for you. You have to do it. So it's important to obviously generate good habits, which is something that I want to keep preaching on this video and other videos, podcasts, blogs I do is good habits. Good habits means starting as early as you can, educate yourself, consistently make contributions. We understand things happen in life. If you can't put in 7,000 or 8,000 bucks, put in something. Keep your good habits forming. And thirdly, just trust the process. Sit back and relax and enjoy and watch your money grow. Whether you're investing in stocks, mutual funds, ETFs, real estate, gold, doesn't matter. It shouldn't matter. Over a 30, 40, 50-year period, you should generate an 8 to 12% rate of return. And if you do that, your money should double every 8 years at least. And you can just calculate those figures in your head, and you'll understand quickly that you can have potentially 7 figures for sure, 6 figures guaranteed, 7 figures for sure if you start early, you're consistent, and you trust the process. Okay, so you get a deduction for putting the contribution in. What's a deduction? You make, for example, $50K, you put $6,000 in an IRA, you only pay tax on 44, right? So the deduction reduces your tax basis. Doesn't reduce your tax liability directly, it indirectly does. A credit directly reduces your tax liability. A deduction reduces your tax base. Deductions are great. Credits are better, but trust me, deductions are really good. The second carrot they gave us for saving, remember, pre-1974, Americans didn't really have a chance to save. If you didn't work at a large company, you did not have a retirement account. Meaning you were stuck, begging for money, hoping you saved Social Security, things like that. ERISA was a great, great body of laws, okay? The retirement system is amazing. It works. The IRS is basically telling us, listen, guys, we know you don't love to save. We know you love to spend. So we're going to encourage you in 2 ways to save. We're going to give you a tax deduction. And on top of that, we're going to let your IRA grow without tax. That's known as tax deferral. Meaning the money in your IRA is not subject to tax. So if you start with $6,000, you buy Tesla stock and you sell it at $12,000, it all goes back to your IRA without tax. There is no tax. No capital gains tax, no ordinary income tax, no tax, zero, zip. That allows your money to grow faster. That is known as tax deferral. So in order to incentivize us to save, they gave us the deduction and the ability to generate tax deferral. Now, in order to kind of tempt us not to pull that money out too early, they created these distribution rules, meaning if you're under 59.5 and you take the money out, you have to pay tax and a 10% penalty. If you're over 59.5, just income tax, right? So they're trying to make you hold off pulling the funds out prematurely, which is good. Once you hit 73, you have to take out what's called a required minimum distribution, which is approximately 3% or so of your IRA value. Why are they doing that? They're saying, listen, we gave you all these incentives, right? Tax deduction, tax deferral. The gravy train can't last forever. Give us some of that money back. Now, it's a little bit hard to read, so I'm going to read it for you, and hopefully we'll post this in the notes. But not everyone can set up a traditional IRA, okay? Why? Foolish, right? The IRS basically is trying to limit deductions. Deductions are good for taxpayers. They're not wonderful for the IRS. Why? It reduces your tax basis, so that means they collect less tax revenue. So first rule, if you don't have access to a 401k at work, or you're married and your spouse doesn't either, then irrespective of your income, you can set up a traditional IRA. You make $1 million or $100 billion a year. If you don't have access to it, employer 401k or your wife doesn't or husband doesn't, you're good to go. However, if you're single and you have access to a 401k at work, if you make more than $87,000 in 24, you can't set up a pre-tax IRA. Stupid, right? Like they're really just trying to limit the deduction. But we'll see. There's other options like the Roth. If you're married, filed jointly, and the spouse making the IRA contribution is covered by an employer plan, even if you don't contribute, but the employer you work for has a 401k, if you make more than the 143, you can't do a pre-tax IRA. Now, if you want to contribute to an IRA and your spouse is covered by a 401k at work, not you, but your spouse, if you make more than the 240, you can't do a pre-tax IRA. Again, they're just trying to limit deductions, but just important to keep these deductions and income limitations in mind. So that's the pre-tax IRA. The pre-tax IRA, that's all you need to know. It's that easy. It's not complicated. It's the most popular type of IRA. There's 65 million IRAs, about $13 trillion in IRA funds. The majority are in traditional IRAs. Now, the Roth IRA is making a big comeback. Not just because it's a great retirement account, but actually the government wants us to all set up Roth IRAs. Stupid, right? You would say, why would the government want us to set up a Roth IRA? Makes no sense, right? Once you're 59 and a half and the Roth's been open at least 5 years, it's all tax-free. Why on God's green earth would they want us to have Roth IRAs? In 10, 20, 30, 40 years, the government's not going to have as much tax revenue to collect if we're all in Roth IRAs. How does that make sense? What's wrong with us? Well, this is the problem. Governments really only think forward 4 to 8 years, right? Once they're out of power, they should care what happens to this great country of ours, but they don't, unfortunately. How do we know they don't? It's because they're pushing us into the Roth IRA. The Roth IRA is after tax. You do not get a tax deduction for making a Roth IRA. A traditional IRA, you get a tax deduction. Now, I mentioned earlier that the IRS, Treasury do not like tax deductions. It lowers your tax revenue, lowers the tax base. They like after-tax IRAs, like them today. They like traditional IRAs in 20 or 30 years when they're collecting the distribution tax. They're not going to like Roth IRAs in 20 or 30 years. They like them now. But short-sighted, yes, agreed, but governments love Roth IRAs. That's why they are trying to Rothicize our retirement industry. They're trying to push people to set up Roth IRAs. They're trying to push people to set up Roth 401ks. They now have a Roth option and a SEP IRA. They have a Roth option and a simple IRA, which we'll get to shortly. They've made Roth options for profit sharing and 401ks. Why? They want to Rothicize the retirement system to limit the amount of current tax deductions. Is that smart? I don't think so. But the government doesn't really focus on what's going to happen in the future. That's someone else's problem. So Roth IRA was created by Senator Roth of Delaware in 1997. I remember looking at the Time magazine when Senator Roth was on it. And I remember thinking, what the heck's a Roth IRA? I was in law school. I'll never forget it. And who would have almost 30 years later, right? We're still talking about Roth. It's a great plan. I've written a book called In God We Trust and Roth We Prosper. No, I don't have it in front of me. It's a great retirement account. All my retirement accounts are Roth, personally. Why? I'm not worried about a tax deduction. I'm more focused post 59 and a half. Everything I pull out is tax-free. If I die, I can leave it to my spouse tax-free. My spouse, God forbid, passes. My kids get 10 years to use those funds tax-free. That's exciting to me. For IRAs and Roth IRAs, contributions are due April 15th. 23, like a traditional IRA, 6,500 or 7,500 if you're over 50. Number is now 7 or 8K. No RMDs if you're over 73. So that allows the Roth to keep growing. If you pull that money out pre-59 and a half and pre-owning it 5 years, tax at a 10% penalty. Except Roth contributions, whatever you put into a Roth IRA, you can pull out tax-free anytime you want. It's only the earnings on the Roth IRA that are subject to the 59 and a half and 5-year rule. Okay. Eligibility, as I mentioned, if you make more than $240,000 in 2024 married, you can't do a Roth IRA. But, big BUT. There's something called a backdoor Roth IRA. Since 2010, there are no income limitations for Roth conversions. Before 2010, if you made more than 100K, you could not do a Roth IRA conversion. We all know what happened in 2008, 2009, financial market crash. Economy was in shambles. Guess what? Government needed money. Best way to collect money, or one of the ways to collect money, is Roth conversions. Why? You're prematurely enticing people to pay tax. A Roth conversion is a taxable event. You pay ordinary income tax on the amount of the conversion. So you are enticing people to pay tax early. Now, we've just talked about the fact that Roth conversions are great down the road. 59.5 in 5 years, pull everything out tax-free. But in 2010, government needed money. So if you could prematurely force people to pay tax early, it's a win for the government. And they needed the money. So they did it. And they basically reduced and eliminated the income limitation for conversion. So by doing that, they opened the door to something called a backdoor Roth IRA, which I've been talking about since 2010. In fact, they allowed you to pay the tax over 2 years. That's how much they needed the money. So the way it works is if you want to do a Roth conversion, you pay tax, right? If you make more than 240, married, filed jointly, we know the rules say you cannot do a Roth IRA. How does the backdoor Roth IRA work? Simple. You open a traditional IRA. I just talked about it, but you don't take a tax deduction. You put in up to 7 or 8K for 50, or you can still do one for 23 up to April 15, 2024. And then you literally open a Roth IRA as well, and you literally move the money from the IRA to the Roth. Since it's after tax, assuming you didn't reinvest those funds, there's no taxable income. And you literally move the money from the IRA to the Roth the same minute, the same day, the next day, whatever, tax-free. The IRA custodian will 1099-R, zero conversion fee, right? Because you moved $6,500 from the after tax to $6,500 in Roth, no gains. And now you have a Roth, and you made more than 240. One thing to remember is when you do backdoor Roth IRAs, there's something called a pro rata formula. And that means that if you have other pre-tax IRAs out there from previous years, and you want to do a backdoor Roth IRA, there's a formula to determine how much of that backdoor Roth IRA would be tax-free and what is taxable, right? Because they want you to have to take into account a pro rata percentage of your other pre-tax IRAs when you do the conversion. So for example, I have 5K in a pre-tax IRA from previous years, and I want to do a backdoor Roth IRA of 5K. The way the formula works is if I didn't have a previous IRA, I can automatically just do the backdoor Roth IRA conversion of the 5K tax-free, no tax. But because I have a previous IRA of 5K, the formula says you add the 5 and 5, that's 10. The amount you want to backdoor is 5. 5 out of 10 is 50%. So 50% of that backdoor, 5,000, 2,500, can go Roth. The other 2,500 would be subject to tax. So just keep that in mind. If you have other pre-tax IRAs and want to do a backdoor Roth IRA, you just got to keep that in mind that not everything will be tax-free. Okay, let's move on to the SEP. The traditional IRA and the Roth IRA are both individual retirement accounts. They're set up by individuals. Now, if you want to make contributions, I mentioned you have to have an earned income. You could still set up a traditional IRA or Roth IRA, even if you have no income, you just can't make contributions. Why would you do that? Well, you used to work at Apple or Tesla, and now you have 200K in your 401k. You leave your job and you want to put it into an IRA, you're able to open an IRA account. Even if you're retired, don't want to earn any more income, you can still open in the IRA. You just can't put any more money in unless you have enough earned income. A SEP IRA is set up by a business. Any business can set up a SEP IRA. Generally, it's set up by small businesses, 1 to 10 employees. A SEP IRA is a pure profit sharing plan, and I'll compare and contrast it with a 401k momentarily. When I say a pure profit sharing plan, it means this. If you're a sole proprietor or single member LLC, you can do 20% of your net Schedule C up to 69K or 66K. Well, this should say 66, a typo. It's not 636, it's 66. So 69K in 24, 66K in 2023. If you're a W-2, it's 25% of your W-2 up to 66 or 69. For example, you have a SEP IRA, just you, 100,000 bucks, sole proprietor, you can do 20% of 100, 20K. 100,000 W-2 in an S Corp, you can do 25,000. There's a formula reason under the Schedule C rules why it's 20% and not 25. But just for simplistic purposes, just trust me on it. It's 20% Schedule C, 25% W-2. Okay. Contributions can be done up until the business files its return. Right? It's a business plan. If you're self-employed, you can set up the SEP. If you have a single member LLC, a C or S Corp, you can set up the SEP. If you work at Apple and you're not self-employed, you can't set up a SEP. You can contribute to the Apple 401k, and Apple can set up a SEP, although we'll see why they set up a 401k in a moment. But you need to have a business. Profit sharing. It could be pre-tax or Roth, starting in 23. The pre-tax, the company gets a deduction. Remember, these are company deductions, company contributions, not you. Company makes the contribution. Now, if you're self-employed, then you own the company. That's fine. Indirectly, you're making it. But it's a company profit-sharing contribution. If you decide to make a Roth contribution, you have to pay tax on what your contribution is. So let's say you make 100K, sole proprietor, single member LLC, 100,000 Schedule C, you put in 20K. Pre-tax, you get a deduction. If it's Roth, the company still gets a deduction, but you got to take the 20K into income. Why? If you didn't, it'd be unfair. You'd get a double benefit. You get the deduction, and you'd have to pay any tax on it. Wouldn't be fair. SEPs are great plans, but they're not 401k. So I'm going to compare and contrast a SEP with a regular 401k and then a solo. If you work at a company like IRA Financial or Apple, the SEPs are very difficult to do. Why? It's a 20% or 25% profit sharing plan. Now you can do 0, you can do 4% or 10%, but it's across the board. And you're obviously not going to be able to put in as much money. So in the case of a 401k in 2024, if you're under 50, you can do 23,000 or 30,500 if you're over 50. Okay? A SEP is just a pure profit sharing plan. So 100,000 bucks and you have a SEP, Schedule C, you can put away 20K. If you had a solo K, you can go up to 23, if you had a regular 401k, you can go up to 23, or if you're over 50, 30,500. There's no catch up if you're over 50 in a SEP. It's 66 or 69K. That's the max. 20% or 25. So again, 401k, it makes more sense than a SEP if you have a business with many employees, or even more than a few. If you're the business owner and wants to max out, and I'm doing 20% of my comp, I got to do 20% to everyone. I got to do 25% to everyone. That becomes expensive. 401k will let each person put in their own employee deferral. Maybe I have to match 3 or 4%, but I'm still able to max out. Now, a solo K, that is a more of a equitable comparison. So let's say I'm a SEP IRA or solo 401k. I'm sole proprietor, single member LLC, and I'm deciding, should I go solo or should I do a SEP IRA? 100,000 bucks, sole proprietor. That's my income. That's Schedule C. SEP, we know, is going to give me 20K. That's it. Pre-tax or Roth. If I did a solo K, I can go 23,000 if I'm under 50, or 30,500 if I'm over 50. Plus, the solo K has also an employer profit sharing component. So it'll give me another 20K. That's either 43,000 or 50,500. Okay, so almost double. And I'm going to do in a couple of weeks. I'll do another masterclass on the solo K. It's important to understand the differences between the SEP and solo. I'll probably do a masterclass in its entirety, looking at the difference between a SEP and a solo K. But that's why the solo K generally wins, and that's why I wrote a book. I don't know. Here it is, on the solo K, because it's such a great retirement plan for the self-employed. And just on the number standpoint, you're going to be able to put a lot more with a solo K. You can also borrow 50,000 or 50% of your account value. When's the only time you should do a SEP? Let's say you make $1 million, under 50 years old. You're going to max out. You're going to hit that 69K, whether you do a solo or a SEP, doesn't matter. And if you don't need the loan, then the SEP would work for you. The other advantage of a SEP is that the IRA custodian does all your paperwork, all the 5498, 1099, all the IRS admin, the IRA custodian does it. If you have a solo K, technically you as the trustee are responsible for it. But if you're a client of IRA Financial, don't worry, we do it for you anyway, so no stress. If you don't use IRA Financial, you had something, let's say at Fidelity or Vanguard, you'd be on the hook to file the 5500 EZ. You don't have that stress with us. SEP's a great plan. Same distribution rules as IRA Roth. RMDs, requirement minimum distributions, things like that. Very peculiar thing. The one interesting thing with the SEP is this. They have this thing called 3 out of 5 year rule. And this is something that you can have some fun with. That means that you only have to offer SEP benefits to any employee that's worked at the business 3 out of the last 5 years. So if you have a new business and you don't want to offer benefits to your employees and you want to have a SEP, you can do 20 or 25% of your comp, and you don't have to offer benefits to your employees until they worked 3 of the last 5 years. So you got some wiggle room there. I still think the solo is a better plan, but I've had some clients say, you know what, I'm going to use that 3 to 5 years, and then maybe I'll switch to a solo. That's your choice. I think it makes sense just to start with the solo, but again, totally your call. But this is a nice little wrinkle that you can kind of use at your advantage if you want to make contributions for yourself and don't want to offer anything to your employees because it's cost prohibitive or whatever reason you have. Again, it's profit share made to each participant. If you do 20% to you, you got to do 20% to everyone. And it's for anyone eligible over 21, makes at least $750. Okay, let's move to the simple. That's the last IRA in the IRA family. It's IRA, Roth, SEP, Simple. That's the 4 IRA family plan. Simple IRA, I call it a poor man, poor ladies, be politically correct, 401k. It's also an employer plan. It has to be set up by a business. It could be a sole proprietor, single member LLC, C or S Corp, even a charity. So it has to be a business. Why do I call it a poor man's 401k, a poor lady's 401k? Because we mentioned, right, for 24 in a 401k, you can go 23 or 30,500 if you're over 50. The Simple is only let you do 16 or with a $3,500 catch up if you're over 50. That's less than 23 and 30,500. For 23, it was $15,500 and $3,500. So why would you do a Simple? Well, a couple of reasons. It's not a popular IRA. It's probably the least popular. I'd say it goes traditional, Roth, SEP, Simple. I think the 401k is a better plan than the Simple. What's the advantage? The advantage is twofold. One, each employee has their own Simple type account. So Adam could do real estate and Joe can do stocks. So that's the advantage. You can have your own little Simple plan. Technically, you can do that also in the SEP, but it also works well with the Simple. The 401k, there's fiduciary ERISA rules. SEP generally and Simple not subject to ERISA. So you have a little bit more flexibility on investment decisions. Number two, the IRA custodian does all the admin. Okay, with a 401k, as I mentioned, you have to generally hire a third-party administrator to do all the work. There's a cost involved. With a SEP or Simple, your IRA custodian, i.e. IRA Financial, will do all the work. 5498, 1099. So it's more cost effective. But you can only put in less money, right? There's the Roth component as well. Before 2023, the Secure Act 2.0, you couldn't do Roths and SEPs and Simples. Now you could. But the bottom line is, why do most people set up a 401k for their business? It's because they want to put away the most amount of money, right? Generally, it's up to the business owner to decide if they want to have a 401k or an IRA or SEP or Simple. And in this case, the owner is not going to be able to put away as much money. Now, if you're a business owner and say, you know what? I only want to put away is 10, 12, 15, 16K, then the Simple could work really well for you. It could be a really good option for you. But if you want, like me, I want to max out. Okay, so every year I can put away an extra $7,000. That's money for me. And if you do that over 20 years, 140,000 contribution probably can lead to $600,000-$700,000 in total net worth. So I want to maximize my IRA, and that's why my 401k, and that's why I chose a 401k versus a Simple for my business. Simple as that, to be honest. Excuse the pun. But again, there are businesses that use a simple, and they're good plans. We have a number of businesses that we have simple IRAs for, and you can self-direct them. You can do traditional alternative. We take care of the admin. So there is value, but the detriment is you can't put away as much money. Okay, who's eligible? You have to have at least $5,000 of income, and on top of the 16,500, well, the 16,000 and the 3,500, the employer also has another requirement. Okay, remember I mentioned with a 401k, most small business 401ks are called safe harbor plans. The safe harbor plan will allow the highly compensated employees to max out, to do the 23,000 or the 30,500 without having them to worry if the plan is top heavy and whether it fails certain ERISA tests like deferral percentage and contribution percentage. So if you do the safe harbor, the IRS, Department of Labor, is basically saying, don't worry about these top heavy ERISA tests. As long as you do at least a 3% match, either elective or non-elective. Elective means you put in 3%. If they put in 3%, non-elective means you put 3% no matter what the employee puts in. If you do one of those two things, you're good to go, and you don't have to worry about failing any ERISA tests. And as a highly compensated employee, you can max out your retirement account and don't worry. Okay. Simple IRA basically says you got to do something similar. If you're going to offer a simple IRA to your employees, that's cool. You can max out, you can do the $16,000 and the $3,500 catch up, but you either got to do a 2% of their salary non-elective, meaning everyone gets 2% of their salary, or you got to do 3% match, meaning if they put in 3%, you got to put in 3% with a wrinkle. You can play around with the match. Okay, you can go as low as 1%, but it can't be for more than 2 out of the 5 years. So let's say you don't want to do 3%, you're tight with money, cash flow issues, whatever. You can go to 1%, but you can't do that more than 2 out of 5 years. Okay, so you have some limitations. Where if you have a safe harbor, you got to do either 3%, elective or non-elective. You can't play around with that number. You can't go down to 1% or 2%. You don't have to do a safe harbor, but then you're going to run top-heavy tests, which we do for a lot of clients. I work with a great company called Pension Investors. They have 1,300 401k plans, been in business since the 70s. So they'll do all these tests. And in some cases, some businesses will say, we don't care about safe harbor. All our employees are going to participate. Like I worked at a law firm for 9 years, big law firms in New York. They didn't do safe harbor. They didn't do any matches for us. Why? Because all the lawyers participated. So they weren't worried about failing top-heavy tests. If you're in a business situation where you think all your employees will participate, you may be able to get around doing the safe harbor. With a simple, you can't. You got to still do that 2 or 3% match. So again, just something to keep in mind. If you decide to do a simple, you're going to have to satisfy the 2 or 3%. Non-elective means everyone gets 2% of their salary. Elective means you only go 3% if they do 3%, and then you can go as low as 1%, but not more than 2 out of 5 years. So that's the simple. It's a poor man's 401k, but it is kind of like a 401k because it is dollar for dollar. It's not a profit sharing plan. A SEP IRA is a profit sharing plan, but as I mentioned, the solo K has the best of both worlds. It is the best of the 401k world. Employee deferrals, 23 or 30,500 if you're over 50. Plus, it also has the profit sharing that lets you do the 20 or 25%. Plus, it has a loan feature. So usually the 401k will solo 401k, if you're self-employed or have no full-time employees other than the owners of their spouses, will beat the SEP if it went head-to-head. But I mentioned, if you're under 50 and you max out, you're going to make $500,000 a year, then you can do the SEP, assuming you don't care about the loan. Traditional individual IRA, Roth, and individual type of IRA, there are income limitations. Roth, no deduction, but once you're 59.5, Roth's been open 5 years, it's all tax-free. Traditional IRA, once you're 59.5, you can pull the money out, but you're subject to income tax. If you pull it out prematurely under 59.5, tax 10% penalty. IRAs and Roth IRAs, SEP, simple. You can always self-direct them. I've done a masterclass on self-directed IRAs. You can check that out. I'm not going to spend a lot of time on them. The IRS doesn't tell you what you can invest in, whether it's a traditional Roth, SEP, or simple, only what you cannot. In 1974, when IRAs were created, It did not distinguish between IRAs that invest in stocks and IRAs that invest in real estate. 3 things you can't do. That's based off section 408 and 4975. And the 3 things are as follows: life insurance, collectibles like art. Thirdly, under 4975, any transaction that directly or indirectly personally benefits you as the IRA owner, you're disqualified persons. So any lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled by such persons, 50% or more, cannot benefit from the transactions. You can't buy a house and live in it. Can't have your IRA invest in a business you own 80% of, although there is something called a ROBS, which I'll do a masterclass on, which you can do. You can't buy yourself a car or go on vacation with your IRA. Your IRA should make investments to exclusively 100% benefit your IRA. But self-directed IRAs, probably close to 5 to 8% of all IRAs are self-directed. 65 million IRAs, $13 or so trillion. So it's a growing marketplace. Why do people want to self-direct? They want control. They want investment diversification. They want to be able to invest in assets they know and trust. They want to hedge against inflation. Some people just don't trust Wall Street. Some people just want to drive by the house they own in an IRA and say, hey, I own this house. I can sleep well at night. I don't have to worry about inflation or what's going on in the stock market or on Wall Street. I don't care who's the president of the United States. I know that I can rent this house out no matter what. That's the beauty of America. We're free to invest in almost anything we want except the 3 aforementioned items I mentioned: collectibles, life insurance, and prohibited transactions under 4975. Okay. Types of self-directed IRAs. Again, just briefly, if you want to learn more about self-directed IRAs, definitely check out the masterclass on the YouTube feed, or you can go to our website and read the hundreds of thousands of blogs I've done on self-directed IRAs or the podcast. But 2 self-directed IRA products, really, and a third, actually. Yeah, I'm going to talk about the trust, which I'm starting to focus more on. I'll explain why in a minute. So there's a good old-fashioned self-directed IRA. I call it a full service. So run-of-the-mill self-directed IRA, you open an account at IRA Financial, you move your money tax-free in, and then the self-directed IRA makes the investment into the alternative asset. The only difference between a self-directed IRA at IRA Financial and a quote-unquote self-directed IRA at Schwab is we actually let you self-direct. You can buy more than stocks and publicly traded securities. You can do anything you want except those 3 aforementioned items. The self-directed IRA LLC, same rules as self-directed IRA, except an LLC is stuck in between. I don't have a diagram. I should have. Well, just think of a self-directed IRA LLC. You have the IRA here and the LLC below it. The IRA invests in the LLC, and then the LLC makes the real estate or other investment. Title's in the name of the LLC, not the IRA. The LLC gives you limited liability protection. Control is the manager, right? It's owned by the IRA, managed by you, giving you checkbook control. Limited liability protection, you get privacy. Title's not in the IRA, and control. As the manager, you can write checks to make investments, pay taxes, pay the contractor, the plumber, electrician. A little more freedom, a little bit more control. Same prohibited transaction rules, but you're in the driver's seat, and you get the limited liability protection, which is super important for real estate, or if you're focused on privacy, you want to invest in an investment fund. You don't want your LPs to know that you're using an IRA. The LLC works well. The trust. Okay, I was the first to use a self-directed IRA trust. I started this back in 2009. And then I kind of stopped using it because I always felt the LLC just is an easier model to work with. The LLC laws are more uniform across all 50 states. Very minimal franchise fees per LLCs. Trusts, more complicated. Each state has their own specific trust rules. But the advantage of the trust is you don't need an LLC, good or bad. But starting in 2024, there's something called Corporate Transparency Act, which I'll do a masterclass on. I've done a bunch of podcast blogs and videos on. And under the Corporate Transparency Act, a entity that is owned 25% or more by a person or managed by a person that has substantial control over it has to file a beneficial ownership interest report, or BOI, within 90 days of filing the LLC, or any LLCs formed before January 1, 2024. Within 2024 has to file a BOI, whether the company was set up in the 70s, 80s, 90s, or 2000s, including self-directed IRA LLCs. Why? Even though the IRA owns the LLC, If you manage the LLC, you technically have to file a BOI disclosing your beneficial substantial control over it. Now, a trust does not have to file a BOI. So I've had some clients say, hey, Adam, I don't want to do this BOI, even though we do it for you guys. It's not really a pain. There's nothing to be worried about. Treasury is just focused on stopping money laundering, criminal enterprises. If my clients are not into money laundering or criminal enterprises, people are using IRAs to diversify, grow their IRAs. So don't worry about it. But if you are and you just don't want to deal with it, the self-directed IRA trust will let you get around it because trusts are not subject to BOI. You don't have to pay each year to a state for your privilege of doing business in that state, but you lose the limited liability protection. You get the privacy, you lose the limited liability protection. You also get the checkbook control. So I'm going to start focusing more. I'm doing a really lengthy blog. I've been spending the last 2 weeks going state by state, going through all the state tax rules, franchise tax rules, and determining whether IRAs are tax exempt in that state for any grantor trust income that flows through, because this trust would be a grantor trust, right? A trust is created not by a state, by a contract between three parties: a grantor, a settlor, a trustee, and a beneficiary. So that's all you need to create a trust. So if I hire John to watch my kids and have a contract, that could be a trust, right? I'm setting up this trust. John is controlling the trust, watching my kids, and my kids are potentially the beneficiary. So you can set up trusts for your death, for your life. Grantor trusts, meaning the grantor could revoke the trust at any point, or it could be irrevocable. A self-directed IRA trust is a grantor trust that is revocable. That is revocable, excuse me, not irrevocable, because you can end it anytime you want. The advantage is no BOI, no LLC filing, checkbook control. Disadvantage is no LLC, no limited liability protection. So I will do more information, whether I will provide more information, whether it's through video, podcast, or blogs on the self-directed IRA trust, which is a product I'm going to start working closer with. I mentioned the prohibited transactions. They're simple. We'll go through them in detail in another masterclass, but it's basically three things: collectibles, life insurance, and 4975 disqualified person transactions. You're there. Okay. What's an IRA custodian? You need an IRA custodian to open an IRA. You can't open an IRA at Walmart. Three parties can open an IRA: a bank, a financial institution, or a state chartered trust company like IRA Financial. We're not a bank. We use Capital One or UBS as our bank for client funds. We are regulated by the South Dakota Division of Banking. Our charter allows us to custody IRAs. We focus on alternative assets. That's our specialty. We have over 23,000 clients, over 3.3 billion in assets. We take care of all the IRS reporting, the 5499, 5498, the 1099-R. If you're doing distributions, contributions, conversions, we'll assist with all that. But what I think separates us from everyone else is we don't just establish the IRAs. We also have a very important consulting service that lets us do tax filings, tax reportings, right? I mentioned if you have partnership returns, the BOI, the 1065, we have UBIT, which I'll do a masterclass on. We'll file the 990T. We kind of help you A to Z. If you have research, we do it. If you need to consult with attorneys, CPAs, we do it for you. We're a one-stop shop, and that's what separates us. If you go to another custodian, they're not going to give you any answers on conversions, prohibited transactions, rollovers. We help plan design. If you want to do an investment into private equity, real estate, you want to block UBIT, you want to come up with different foreign strategies for investments, blocking UBIT, maximizing efficiency. That's what we can do. And that's built in and bundled into our price. Why does price matter? Well, fees matter. Okay. I've been really focused on this the last couple of weeks because just doing an analysis, I just did a blog on this. We have a flat fee model. That's something I'm really focused on and really believe in. I believe the whole idea of a self-directed IRA is it's self-directed, right? You're in charge of the investment. I don't make the investment. Whether you buy real estate A, investment B, property C, gold D, crypto E, you decide. It's your money. By law, I'm not allowed to give you investment advice. IRA Financial is not regulated by FINRA, by the SEC. We're not allowed to sell products. We're not in conflict with you. We're on your side. Okay, we work with you. We want to help you. I don't want to charge you more because you were successful and are a great investor. I don't want to charge you more because you started with 300K, now you have 3 million. God bless you. I want you to keep that money. And the studies have shown, whether it's through 401ks or IRAs, a lot of the leakage and the value of your retirement account is through fees. Okay, so we believe in charging you a flat fee. And the blog I just drafted will show you that if you, over a 10-year period, if you have $500,000 in your IRA, if you use IRA Financial versus a competitor that has, and I blended in, valuation fees from a number of competitors, you're going to save close to $18,000 over a 10-year period by choosing IRA Financial. Now, we're going to give you the same service, if not better. All the custodians follow the 5498s, 1099Rs. Plus, obviously, we have consulting and tax reporting, tax filing services. But the core functions of a self-directed IRA custodian is the same, whether you pay me $2,000 or $460 a year. Same thing. Same thing. Why pay more? It's crazy. You should get the same service. And why should you pay more? Because you were successful as a self-directed investor. Now, again, I have money managers. I'm okay paying them 75 basis points of my assets under management. I'd rather pay them when my assets go up. But if I was up 10% last year and they helped me do it, which they did, they picked the stocks, they picked the investments, the mutual funds, the ETFs, I get it. It makes sense why they should charge an asset valuation fee. It doesn't make sense if I'm telling them what to invest in. If I said, hey, buy fund A or fund B or real estate A, real estate B, why should they charge me 75 basis points? That's crazy. I shouldn't pay. I should pay the flat fee because I'm making the decisions. That's why fees matters. And that's why I think, again, if you don't use IRA Financial, just pick a custodian with flat fees, please. I hope you choose IRA Financial, but for whatever reason, you didn't find us before, and you're with another custodian and you're happy, great, God bless you. But make sure they charge flat fees. If they're charging you asset valuation fees, we don't even charge transaction fees. You have an IRA with us, you can have 10 assets in the IRA, you still pay the same fee. Other custodians will charge you asset fees, we don't. We don't even charge check or wire fees. Yeah, no wire fees. So it's flat, 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 flat. Plus, if you do conversions, distributions, we don't charge for that. If you want us to do research and you're part of our compliance service, we don't charge for that. We have a flat compliance service of $299 or $399 for solos. That includes all tax reporting, tax filing, and all research, all consulting. Go find a lawyer that's going to give you consulting service for $300, or we'll file a partnership return or a UBIT return for $299. Not going to find it. We lose money on it, but it's a service we think is important. We believe it's important for our clients to have, because at the end of the day, we're here to protect you. We're here to protect your IRA, and we want you to grow your IRA. We don't want there to be any conflict. I don't want you saying, hey, Adam, yeah, I think my IRA was worth $1 million, but I'm going to tell you it's worth 600 because I don't want to pay you more fees. That's a conflict of interest. I don't want that to happen. I want you to have an IRA. I hope all my clients have $10 million in IRA when they're done. That's a dream of mine. I'm on your side. I'm with you guys. I'm on your team. You shouldn't have to pay me more. There shouldn't be a conflict of interest. I want you to do well. And I shouldn't make more fees because you're smarter than me. That's crazy. So that's why I love our flat fee model. I want to be on the same team as all you guys. I want to support you guys. I don't want there to be a conflict. I want to be on your team and work with you guys in designing and developing and building your IRA. So thank you. That's today's, here's some steps how to get started. How to get started is easy. Go to our website. You can download our app, go on our website, open an account, takes 5 minutes. You don't need any more info. Obviously, we literally wrote the books. Here's, I don't know, three of the books I wrote. I've written 8. They're somewhere here. I don't want to be obnoxious and show all the 8 books on my desk, so I just pick a few of them. But yeah, I think we literally wrote this book. I've been doing this 14 years. I will debate anyone on the stuff. You're not going to find someone who knows more than me on this. So bottom line, I can ask my wife. I don't know how to turn Netflix on, but I know this stuff cold. Okay, some questions. I have an IRA LLC with you. Great, thank you. I'm a sole person buying Bitcoin. Is there an advantage of keeping this arrangement versus going back to IRA, buying the Bitcoin ETF? Listen, good point, good question. Bitcoin ETFs are cool. We're working on a cold wallet strategy. There's the McNulty case, which is a precious metals case. It came out in November 2021. Doesn't talk about cryptos, but it does talk about unfettered command. There is, gray. There is some issue. Are you allowed to hold the cryptos off the exchange in a cold wallet? I'm not sure, to be honest. Some would say no. Some would say yes. Some would say cryptos are different than metals. Blockchain will show the IRS who owns this, whereas metals, no one knows. It's a black hole. But we're trying to work on a multi-sig option so you can hold the cryptos off an exchange and keep control of it. I get it. People have some concern over exchanges. We all saw it with FTX. I get it. ETFs are a good model too. I have nothing against ETFs. If you say, hey, I want to move into an ETF, I don't see an issue with that, assuming you trust the ETF provider. I think getting exposure to Bitcoin is great. Personally, I'm a big believer in it. I do have issues with the exchanges, right? We have partnered with Bitstamp. We think we have a great secure platform. I love our platform, but I respect people that want to buy it through an ETF. I don't think that's wrong either. I work for a Fortune 100 company, and they have me designated as a highly comp employee. Am I prevented from after-tax contributions to my 401k? Great question, Daniel. You have to ask them, number one, if they offer a mega backdoor after tax. A lot of big companies do not. If they do, they're going to have to run that test to make sure enough rank and file employees are doing the backdoor. Because I've had clients, and I've actually had friends that have done backdoor after tax. And what a backdoor after tax, a mega backdoor, is it lets you go dollar for dollar, 69 or 76.5 if you're over 50 and 24, 66K or 73.5 and 23, dollar for dollar after tax. If you're a Rother like me, it's the ultimate prize. We don't do an IRA Financial because we don't have enough people that will do it. So if I just do it or a couple highly comps, you got to still do the ERISA testing. We're going to fail the top heavy. In your case, Daniel, I don't know. You got to ask your plan administrator / HR, your 401k team, to see how they stack up on that issue. Are they comfortable they're going to pass it? If they passed in the past, they should have the figures because they know who's contributing. I've seen figures in the Wall Street Journal. They say about 25% of Fortune 500 companies offer the backdoor. I think it's way less. And I'm not sure, even if they offer it, that they're still going to allow it to happen each year, because I'm not sure there's enough folks, rank and file folks, doing it, which will then fail the ERISA test. So it's a good question. I'm not sure I can answer it for you, Daniel. Technically, if your plan can pass the test and they offer it, you should be able to do it. Is there a brokerage house that is affiliated with IRA Financial for investments? Yeah, there's a number of brokerage firms that we work with. Some of the traditional ones lately have been more difficult, like the Schwabs and TD. We're actually working on a relationship, TradeStation or Tastyworks. Those are the two brokerage firms that have been really easy to work with, where you can open up an IRA LLC or solo 401k account and get brokerage activity and brokerage options through. So thank you, Fred. Good question. That's it. It's almost an hour. I can talk about this stuff forever. I hope you guys enjoyed the video. I really think this stuff's important. I wouldn't do it if I didn't otherwise. I know it's a bit boring. I try to keep it as enjoyable as possible. You probably don't love hearing me talk for 50 minutes. I wish I could condense it, but the stuff needs to be understood. If you got to watch this in different parts because you get tired of me talking, I get it. If it puts you to sleep, I get it. But it's important stuff, and this is what it's all about. If you want to have 7 figures tax-free, you got to understand the basics, right? You can't make a 12-course meal if you don't know how to work an oven or a microwave. Well, I shouldn't say microwave, an oven. So you got to understand the basics. Once you get the basics, you're going to understand how the Roth works, how the IRA, the SEP simple. You can understand what's the best retirement plan for you and your business. You can maximize your benefits, come up with a strategy. If you don't understand this stuff, work with us. We'll help you. We're the experts. We will design strategies. My clients average close to 15% rate of return on their investments. And again, I don't care what they invest in. The bottom line is, if you're doing alternatives, you're doing stocks, if you're diversifying, if you understand how it works, you're going to put together the right program. You're going to decide if it's IRAs or Roth, and you're going to be able to decide what works best. If you don't understand, we will help you do it. And we do everything A to Z. We'll help establish the IRA, the 401k, the SEP, the simple, the Roth. We'll custody it. We'll help with the transfer. We'll help with the rollover. We'll help with distributions, with conversions, with the investment. You want the LC. You want the trust. We'll explain what's best. We'll offer you consulting service. You have UBIT. You have partnership return filings. We'll take care of it. You need your required distributions. We'll take care of it for you. We do everything. There's nothing you'll ask that we won't be able to help you. If we don't know the answer, and guess what? Not everything's in this brain. I'll find the answer. I have a team of attorneys and ERISA attorneys that I can just text and find the answer. I don't know everything, but I learn every day, and I try to better myself and become the best attorney I can in the space, and hopefully educate all of you. That's what I look forward to every day. And I try to grow and get smarter and wiser so I can give all you better and smarter content. If you missed this, don't worry. Just when it's done, it will be live on YouTube. I'll get this PowerPoint also presented on YouTube so you can check it out. Also get it on our website. And that's it. You can always reach us by phone, email, chat. Yeah, by phone. We love talking and hearing from people. Whether you're a client or not, we want to hear from you. So that's it. I hope you enjoyed today's video. Have an amazing rest of your day. And next week, I don't know how I'm going to do this. If you have comments, whether you like Wednesday, Thursday, or Friday, let us know. Let's change it up. But I'm going to keep doing this for as long as until I run out of topics. I'll do master classes. Probably go for a couple of years. I love these things. I hope you guys enjoy them. Thanks for participating. Have a great day. Ciao.